Hey cousins, back with another video. In our previous videos, we covered the basics of wealth creation, how money is created, and how government policies work in conjunction with central banks to shape the financial system. If you haven't seen it, make sure to check it out because it sets the foundation for what we're diving into today. In today's video, we're taking a deep dive into the nitty-gritty of trading. We are getting into essential terms and units that every beginner should know getting into or getting started in trading. Whether you're new to the world of Forex or just need a refresher, this video will equip you with the knowledge you need to navigate the market confidently. We'll be covering key concepts like pip value, leverage, how leverage can amplify both profits and losses, spreads, what are they, and how do they affect your trades, swaps, the cost of holding trades overnight, brokers, who are they, and how to choose a good one, and also lot sizes, understanding different lot sizes and how they affect your position and in the long term your trading. By the end of this video, you'll have a solid understanding of these key concepts and be ready to move forward with your trading journey. So let's get into it. In the world of trading, terms like pips and points are commonly used to measure price movements, but they apply to different markets. While they both describe price change, pips are specific to foreign exchange trading and points are typically used in the futures market. Let's break it down clearly. A pip stands for percentage in point and represents the smallest movement in the currency pair. In most currency pairs, a pip equals 0.0001 of the exchange rate, but for pairs like the Japanese yen pairs, a pip is equals to 0.01. For example, if GBP USD moves from 1.050 to 1.051, that's 1 pip change. If USD JPY moves from 110.10 to 110.11, that's 1 pip change. A point, on the other hand, refers to a full price movement in the futures contract or asset. The value of the point varies depending on the asset being traded, and it represents a 1 unit change in price. For S&P 500 futures, a point equals 1 point change in the index. For crude oil futures, a point represents $1 per barrel price change. For example, if S&P futures moves from 3,200 to 3,201, that's a 1 point change. If crude oil moves from $60 to $61, that's a 1 point change. I want to touch on some important concepts in your trading. One of them is leverage. Leverage allows traders to control a large position in the market with a relatively smaller amount of capital. It's like borrowing money from your broker to amplify your buying power. For example, with a 1-to-100 leverage, you can trade $100,000 with just $1,000 in your account. What are the pros of doing this? It amplifies your profits, allows bigger trades with less capital, but the cons, on the other hand, amplifies losses, increases risk of blowing your account, and so on. Leverage is powerful but risky. Use it wisely with proper risk management and do not chase quick profits. In trading, survival comes before success. 1 to unlimited leverage means there is no cap on how large a position size can open relative to your account balance. In theory, you could open any size of any trade, even with a tiny deposit. It's like trading $1 million with just $10. This is made possible by only selected brokers. The next I want to touch on is a spread. A spread is the difference between the buy, which is the ask price, and the sell, which is the bid price of an asset. It is the cost you pay to enter a trade, and it is how brokers often make money. Unlike commissions, which are transparent, spreads are often built into the price you see on your platform. The tighter the spreads, the lower your cost. Always compare spreads before choosing a broker, especially if you are a shorter time frame trader. Like me, being a day trader, the spreads are extremely important for me. I would like to talk on the impact of spreads on your trading. As a scalper, as a day trader, spreads are crucial. Even 1 pip spread can eat into your profit over multiple trades. For swing traders and longer term investors, spreads may matter less because they run for longer, and they don't really matter because they trade the longer time frames. For higher time frames, spread do not really matter in the grand scheme of things, right? But the spreads are important because they compensate brokers for providing liquidity and executing trades. It's a crucial part of market functions, especially in decentralized markets like the Forex market. A broker is an intermediary that facilitates your entry into the financial markets, basically. They provide the infrastructure, platforms, and tools needed to trade assets like stocks, forex, commodities, and cryptocurrencies. Brokers play a crucial role by connecting traders to the market and charging fees in return for their services, either through spreads, commissions, or other costs. They are basically three different types of primary brokers, and one of them is the market makers. These brokers set their own buy and sell prices, profiting from the spreads, which is the difference in the price, the buy and sell price. They usually offer fixed spreads, which makes them more accessible to beginners, but can sometimes lead to higher trading costs. The next ones are ECN brokers. ECN brokers provide direct access to the market by matching buy and sell orders from different traders. They charge a commission per trade instead of relying on spreads. This results in tighter spreads but requires a higher initial deposit. Then the last is STP traders. STP traders route orders directly to liquidity providers like banks and financial institutions, offering faster execution. They either charge a small commission or widen their spread slightly, providing access to real market prices. How do brokers make money, you would ask? Brokers typically make money through spread. That is the main way they make money, because most beginner traders use spread. Another way they make money is through commissions. This is like a fixed money you are charged. Other ways they make money is through swap fees. Swap fees are for basically swing traders that hold long positions overnight, and these are influenced by interest rate and other differentials. When choosing the right broker, selecting a broker first is already hard enough, but you have to select the right broker because it's like having a partner in the financial markets, right? A broker should be regulated by trusted authorities to ensure safety and transparency. Brokers are essential to trading in the global markets. They offer us retail traders opportunities to actually trade and participate in the global market. Understanding the type of broker you have, how they make you money, and how you choose the right broker is very, very essential to your trading success and your trading experience as a whole. This is the last concept I'll be covering on this video, and it is lot size. A lot size refers to the quantity of an asset, such as the currency or stock you are trading. It determines the volume of your position and plays a significant role in your risk management and professional profit or loss. Lot sizes are crucial for traders to understand, very crucial, as they affect the overall exposure to the market. Types of lot sizes. For the sake of this video, I'll be using GBP USD as a case study, and they include standard lot. The standard lot represents 100 units of a base currency in forex. Trading one standard lot means you're controlling 100,000 units of that asset. So a price movement in a standard lot is equal to $10 profit or loss. The next is mini lot. It represents 10,000 of the base currency in forex. It's 1/10 of the size of a standard lot. A 1 pip movement in a mini lot is equals to $1 profit or loss. Then the micro lot represents 1,000 units of a base currency in forex. It's useful for traders who want to risk smaller amounts per trade. 1 pip movement in a micro lot is 0.1 profit or loss. I advise this for traders, for new traders just getting into the market, giving them a feel of how it is to be in the market. Then the last is a nano lot, means you're controlling 100 units in the market, and 1 pip movement is 0.01 profit or loss. This is not the best, right? Because you're basically not trading anything. So why do lot sizes matter? Lot sizes directly impact the amount of money you risk per trade. A larger lot size means more exposure to the market, more you can make, more you can lose, leading to higher potential profits, losses. The lot size should always match the size of your trading account, regardless of whatever. Risk management is important, right? While leverage can actually amplify your gains and loss, it is also important, to align your lot size with your risk management and your account size. So in conclusion, I would like to end this video because I've been speaking about it a lot, right? Lot size determines the scale of your trade and is a vital factor in your trading strategy. Understanding how lot sizes work helps your risk management, helps your psychology, and also ensures that your trade aligns with your account size, trading plan, and your overall goals. Whether you're trading standards, minis, nanos, adjusting your lot size allows you as a trader to know the amount you are willing to expose and manage your risk effectively. So we've come to the end of this video. I know it was a very, very long video, and if you found value in this video, make sure to like, subscribe, and make sure to leave me a comment. I would like to know what you think in the comment section below. Also, I will also entertain your questions. I want to know what you think. If you have any questions, I'll always answer. You can reach out to me on my DMs on Instagram. I'm always willing to respond. On that note, remember guys, play the game to win, and see you in the next one. Peace.